Hi everybody. Well, another eventful week coming up in markets, particularly if you are in Europe or the UK. That's because we have the European elections coming up. So perhaps even if you're just trading the euro or the British pound or the FTSE or the DAX, all of these markets should be affected in one way or other from these elections taking place. We did mention in last week's video the election taking place this weekend in Australia, but we didn't mention, which is the Sunday at the beginning of this week, is that we have a meeting by OPEC Plus. It's not the official OPEC meeting, but it's a meeting of the major oil producers plus Russia, but minus Iran, probably starting to prepare for how they're going to go about things at next month's meeting. And then we also have the Federal Reserve minutes, which are always well worth watching. So up next, we've got the economic calendar to look through. So you should see that on the screen now. The main highlight, as we suggested, is the Federal Reserve minutes. The important point here is that the market's pricing about a 75% chance that the Fed cuts rates this year, but the Fed are not saying that. So the question then is, does the Fed adjust to this market pricing and turn more dovish? When the Fed's more dovish, that's bad for the dollar. They did do that in December. They did quite a U-turn to the more patient approach that we're seeing now. And so as it stands, according to the Fed, we've got no rate hikes or no rate cuts, just staying pat for the remainder of 2019. So the next step is for them to openly consider lowering rates. We don't think we're quite there yet. So the Fed in the latest speeches are recognizing that inflation is lower and below their 2% target, but they're talking about the reasons being transitory. So that would open the way to a rate hike going into 2020 rather than what the market's looking for is a rate cut this year. So we still think probably the minutes end up being net a positive for the dollar and probably just neutral for the stock market. So as far as earnings this week, we have big ones from the UK. So Royal Mail and Marks and Spencer's stand out as ones I'll be watching. The US retailers propping up the end of the US earnings season as always. And Kraft Heinz should be interesting given that they'll be restating 2 years of earnings because of employee misconduct. So back to those European elections. Obviously, I would say the most interesting from a UK standpoint and exactly how the British parties fare, of course, because of Brexit. A massive win for Nigel Farage's Brexit Party plus UKIP would probably edge Brexiteer MPs to dig in for a harder Brexit. So you would imagine that big win for the Brexit Party, slightly increases the chance of a harder Brexit. That should net be negative for the pound. A good result for the more Remain-like parties, the Lib Dems, Greens, Change UK, would make a softer Brexit a bit more likely, given that the softer Brexit would then have or even a Remain option or even a second referendum would have the kind of little bit of backup from public support if you can read that through the popularity of these parties. All that does assume that MPs are actually affected by public votes, which is a big assumption to make at the moment based on the fact that we've already had a referendum, but many MPs are quite clear-cut standing against the result of the referendum. So again, we think that probably the result of this election at the end, when all is said and done in the UK, is that Theresa May probably doesn't resign as a result of any rout for the Conservative Party in the European elections, and probably still tries to ram through a soft Brexit anyway, be it with the support of with the Labour Party or without. So the British pound has been dropping into these European elections, probing 128 as I filmed this video. It's still in a range, broadly speaking. So the more the British pound drops within this range, the further it falls below 130 just makes it a bit more attractive to buy if you're assuming that the range continues to hold. And obviously you want to buy at the bottom of the range, sell at the top of the range. Still, all that said, the focus has been on the UK, but worth noting that Marine Le Pen is ahead of Macron in some of the polls that are starting to emerge from France. So actually, of course, Brexit often takes the limelight. It may be other European nations, particularly the more Eurosceptic ones like France, who actually cause a bit of a ruckus, perhaps for the euro rather than the pound getting the focus. So as we mentioned, this OPEC Plus is a precursor to the official meeting next month. Oil has been consolidating. Brent hit that peak of 75 and has dipped as low as 69, and the prices are picking up a little bit this week as we head into the meeting. The question being, do we break out above 75, or do we actually turn low and maybe head towards 65? Broadly speaking, for oil at the moment, I would say demand factors, which have been so far quite bullish this year, are turning to be a bit of a drag because of China's still soft economy and the effects of the higher tariffs and the general drag effect on China of the trade war. But supply is a positive force, and that's why oil for the most part has been heading higher this year. So obviously Iranian exports being in the spotlight, but also geopolitics in Venezuela and Libya are positive for the oil price. So then as far as Iran, the question for this OPEC meeting here and then the official one later is, do the Russians and the Saudis fill the supply gap that will come out of the market as a result of Iran? For what it's worth, Trump has tweeted that he already has Saudi support to do so. The net effect of this should be is that if OPEC do in fact raise output, obviously more supply in the market, that should be bearish for the price of oil. 75 perhaps ends up being the top for the time being. But last year we were actually in a similar situation, and what happened then is that OPEC did raise output, but Trump allowed multiple waivers for Iranian exports. So actually, OPEC went ahead, cut output, but we never quite got the reduced exports from Iran. This time, however, it might be different. What may happen is that the waivers don't get extended, is what we've heard so far. But maybe countries who have the power to do so, like China, may flout the waivers anyway. And so again, we don't get the drop in production. So OPEC may be hesitant to cut their production because they don't need to if Iran keep exporting to China anyway. Well, thank you very much for watching the video this week. If you do want to follow these videos as they're released, please follow myself and LCG on YouTube and social media.